Welcome to Fisher Webinars. The following is a recording of Outlook for M&A in Europe's paper industry, originally recorded on Thursday, November 12, 2015.
I'm going to share some of our thoughts today on how M&A may play out in Europe and what the role M&A should or even could have in Europe's paper industry. As in many Fisher webinars, you'll see a number of slides that contain charts and graphs. I think in this case, all of them come from Fisher Solve, which is our global analytical tool for the paper industry. I hope this short webinar will not only offer you some interesting thoughts on M&A, but also inspire you to use Fisher Solve for your own important projects in more and more creative ways. And of course, as always, we encourage you to give us a call and ask for some help thinking about how to do those projects. All right, so we will take a look through M&A with 3 simple steps. First, we'll take a quick look at how concentrated European pulp and paper sector is already. Not all M&A, of course, is designed to do concentration or consolidation, but it's an important aspect. So we'll set that as a base. Then we'll take a look at what does typically drive M&A in the pulp and paper industry and to what extent those conditions are present in Europe. And then with some thoughts on the outlook for M&A in Europe. So let's take those in order. First, just how concentrated is Europe? This is a graph that has pairs of bars, each pair sitting on top of a region of the world, Asia Pacific, Europe, Latin America, and so on. The left-hand pair shows in tons the size of production or capacity in that region, and the stacks are major grades in Fisher Solve. As many of you probably know, Fisher Solve has everything in hierarchy, so major grade is the top of the hierarchy, and those entries are tissue and towel, specialties, printing and writing, packaging, newsprint, and market pulp. So the right-hand bar of each pair shows the number of mills in each region, and that's shown on the right-hand axis. So a couple things to notice. First of all, Europe makes a lot of paper, and in a lot of different kinds of paper. And it's number 2 in the world. It's almost, I mean, it's not quite almost number 1, but it's very close. And if you consider that Europe's population compared to Asia is only 17% that of Asia, you can understand that Europe not only makes a lot of paper for itself, but also is kind of an engine for paper making for the rest of the world. Another thing to notice is that the number of tons per mill that this chart implies suggests that Asia and Europe would have lower tons per mill than in other regions of the world, and this is kind of foreshadowing some of the things I'll say in a little bit. In fact, the next slide gets to it right away. We're using here HHI as a measure of concentration of sectors. It's a mathematical construct that turns us into a single number the the relative concentration of one sector to another using market shares as the input. The maximum possible concentration is 10,000. That would be if one company had 100% of the share. So the bigger the number, the more concentrated, smaller, the more fragmented. And the first thing you notice is Europe, which is in red in the middle. Each of the bars represents a different grade. I'll talk you through that now. So Europe CB, of course, is containerboard. CFS, CGW, the 2 coated paper printing and writing grades. TNT is tissue and towel, and then UFS is uncoated free sheet. And you'll see those pretty much repeated in the bars to the left of that, which are North American, and the bars to the right, which are Chinese and Brazilian. We picked China and Brazil as opposed to Asia and Latin America because Asia and Latin America are, for purposes of concentration, not really regions. They're too big. For example, it's more expensive in most cases to ship paper from Brazil, Chile, Argentina, the southern cone, up to other parts of Latin America than it would be to ship from the U.S. itself. So that's kind of one definition of a region. Does it trade within itself? So we feel that China and Brazil, or China and the southern cone of Latin America, represent regions more effectively. So something to notice is that Europe, in terms of HHI, most cases looks a lot more like developing parts of the world than it does the other major developed region, which is North America. And this is going to have an effect on how M&A will play out in the future. So here's another way of with a quick eye chart, see how concentrated or fragmented Europe really is. This is again at major grade level. So it may be a little bit too aggregated in order to really portray how concentrated Europe is, or how fragmented Europe is, that is. Each bar represents a major grade, and the stacks in the bar represent each a separate producer or company. But I'm going to now switch to the same chart but for North America, and you will see that even at major grade level, North America is a lot more concentrated than Europe is. And so we're going to use North America as a foil to understand Europe, partly because North America is a little bit ahead of Europe in many regards in terms of M&A, and because it's a good comparative tool to see where Europe may go and what is possible with concentration. So some of the key drivers of M&A are four listed on the page. They are cost reduction. Think of it as synergies and efficiencies gained by putting two companies together. Two major kinds: fixed cost sharing. So if two companies don't need two presidents and two sales forces, they need just one. So eliminating some of those fixed costs produces some efficiency. That is one of the drivers of M&A. And then manufacturing platform sharing. So some companies have lower cost manufacturing than others, and acquiring a company with lower cost manufacturing can allow you to make your own products at lower cost and therefore more profitably, and that's another driver for M&A. A second one is diversification and access to the new products, markets, or technologies that an acquisition target might have. So for example, if one company had a lot of production capacity, didn't have enough products to make, acquiring somebody who was successful in certain product lines or markets, or had certain technologies to attack them with, might be a valid justification for M&A. Those two drivers tend to affect the company doing the M&A deal itself, and not really the rest of the market. Consolidation and the resulting market power is a little bit different, because when a market becomes consolidated enough, it tends to make the segment a little less volatile, and prices a little less volatile, and it can often make margins for those participants a little higher. Now, our analysis, and we build models of commodity markets in the paper industry, and then analyze how those markets behave. And we prove to ourselves that concentration starts not when the top 3 or the top 5 have a certain total market share, but when one company achieves a 30% share or more. And in simple terms, the reason for that is that nobody can really afford to take capacity out, for example, if they have a small share of the market. Let's imagine a market where there's 20 companies, each with 5% of the market, and each of those 5%ers operating one machine. Nobody would shut the machine down if there wasn't enough volume. Nobody would do that voluntarily. It would, of course, be financial suicide. But if somebody owned enough share, it might make sense to shut one machine down. You'd get rid of a lot of fixed costs and spread those tons over other healthier mills, and in the process it might adjust the supply-demand balance for that grade, and might have an impact on that company's margins. Consolidation is often one of the benefits of M&A work, and so we're going to take a look separately at whether these conditions are present in Europe. The last one being succession. Companies are often owned by people who, as they age, decide they want to pass their holdings on to somebody else, and if that isn't the family of the owner, that can often trigger an M&A event. There are lots and lots of other drivers of M&A. We just don't have time to deal with them all now, but perhaps we'll give an example of a thought process that you can use if you want to carry this kind of analysis further yourself. Okay, let's take them one at a time. The fixed and variable cost reduction. The chart you're looking at now uses brown linerboard, commodity liner, as an example. It's a cost curve grouped by region. The red on the right is North America, the green on the left is Europe. The thing you should notice is that the red North American curve is a lot flatter than the European. And what this means, of course, is that there are European producers that dearly need a lower cost manufacturing platform, and there are others that have it. Whereas in North America, the industry seems to have competed itself to a little bit more of a stasis than in Europe. So this just has to lead to some pressure or some value for M&A, which is one of the possible solutions to a steep cost curve. Of course, steep cost curves by themselves are not bad, but they do tend to increase the value of lowering costs. You can move a long ways in margin terms by moving a little bit to the left in the cost curve in Europe's case, for example. Now, I'll just say, while this talk is about M&A, there are other ways that markets consolidate besides M&A. I'll just mention it now. Of course, high-cost producers sometimes don't survive, and in fragmented markets in particular, if M&A doesn't come quickly enough, unfortunately bankruptcy is one of the ways that markets right themselves in times when demand isn't strong enough to keep up with supply. Whether demand is increasing or not doesn't matter if supply grows faster than demand, or if demand shrinks faster than supply. It's somebody on the right-hand side of the cost curve who often ends up being left out. So we believe that some of the concentration that will occur in Europe will unfortunately be caused by bankruptcies. Now, if we go down to the mill level, you can see in this chart that North American mills, the pair of bars on the right, are on average bigger and have more buying leverage than those in Europe. So the two bars on the light green ones are the average size. The two dark green ones are the amount of spend that the average mill has. And you can see that at a mill level, and anyway, there's a need for efficiencies. Now, if we go up to the company level, it may even be more so. North American companies are on average bigger than European ones and tend to spend more. Europeans spend more to make each ton. So there's clearly a need, or let's say pressure, for M&A deals to solve this disparity and make European companies more efficient. So I won't do the math for you here, but this is a chart that should make it leap to your minds that there must be some opportunities for fixed cost sharing in Europe. The two bars represent the tons of container board made in each region, and the slices represent companies making those tons, and of course there are a lot fewer companies making a lot more tons in North America than in Europe. So you just have to imagine that even though European companies are often family run and quite lean, every company still has to have a sales force and has to have a headquarters and has to have a president, and so there just seems like there should be opportunities for fixed cost sharing were there to be more M&A work done in Europe. Cost sharing isn't the only driver for M&A. I'm going to give an example that ultimately ended up being a North American one. The red bars represent the trend in capacity of newsprint. Green bars represent the trend in capacity of containerboard, or linerboard that is. And as you can see, one's going down, the other's going up, as you might expect. And in fact, this triggered a recent acquisition by WestRock of SP Fiber, which basically was a newsprint company that had just started to try to convert itself into containerboard and kraft paper. And WestRock got from it a low-cost manufacturing platform, and newsprint got out of newsprint. So it was a win-win for both. And we see this kind of conversion activity throughout the industry, and it well could be the driver of additional M&A. All right, now let's take a quick look at another driver for M&A, the acquisition of diversification, new products, markets, or technologies. In this first chart, the x-axis represents European companies, and it's no longer just containerboard, linerboard. This is all European paper and pulp companies. The y-axis represents the number of countries that each company operates in, and we've defined operates in as operates a mill. Of course, some companies will sell and even convert in other countries, but using mill as the proxy for geographic diversification, you can see that there aren't very many companies that operate in a lot of countries in Europe. European countries are pretty close together, and I think you could imagine that there should be synergies available by sharing costs and sharing technologies and products and product marketing across more than one company. So again, a driver that seems to indicate that M&A activity should be useful in Europe. The next chart is going to look fairly similar, although it represents something different. In this case, again, x-axis represents companies, all European paper companies. Y-axis represents the number of grades made by each company. And in this case, grades is part of the Fisher-Solve hierarchy. Again, major grades on top, grades below. So while major grade might be printing and writing, the grade is uncoated free sheet, coated free sheet, uncoated groundwood, coated groundwood. Or in packaging terms, for example, it might be linerboard, corrugated medium, LES, and so on. And again, in Europe, we see that there's not very many companies making a lot of different grades. And so there isn't a lot of diversification in Europe's paper industry. And that's not necessarily a bad thing. Focus is a good thing. But it is a little odd that the European companies don't have somewhat more diversification, a little bit more like North America. And we think it's indicative of the fact that there is room for more M&A. Now let's turn back to this subject of consolidation and the resulting market power that can accrue. Here's an eye chart for you, but I'm going to make it look a little bit easier to read. The x-axis is time, so it starts at 2007 and ends in 15 to this year. Each pair represents Europe on the left and North America on the right, and as in charts before, the slices represent individual companies. And so you can see that the bars on the left tend to be indicative of a fragmented market, and you can see that those big yellow bars toward the bottom in North America showing increasing concentration. And remember, I said that concentration is a function of at least one company exceeding 30% market share. And so let's look at what's happened over time. Between 07 and 11 or 12, IP increased its concentration level to over 30%. And so the containerboard industry in North America did pass that threshold about then. So now let's go take a look and see whether it actually did have an impact on volatility and or margins of the players in containerboard. So the next chart shows on the x-axis years again, and on the y-axis it shows operating earnings in percentage terms. Now I'm going to divide this chart into two periods, up to and then after 2012, and I think you'd agree that pre-2012 earnings were much more volatile, and after less so, and before the average earnings were lower than after. So it does seem to indicate that consolidation can be a useful tool for an industry segment. So the question is, if it's useful, is it doable in Europe? So here's a picture of European containerboard market shares, and I've circled the four biggest players, and you can see that the leader has only 13%. That's pretty far away from 30% threshold, and the ones below that are 6s and 7s. So I'm going to use as a measure how many companies would have, how many of the top companies would have to consolidate in order to reach that threshold, that consolidation or concentration threshold. Not that that's the way to do it, and in fact there's lots of reasons why that wouldn't happen, but just as a measure, merging the top 4 European containerboard producers would just barely achieve true consolidation in Europe. So, and in fact, if it's only the last merger that would deliver that additional consolidation benefit. As you can imagine, if 2 of these companies combined, there is no exceeding the consolidation threshold of 30%. If a third one joined, still doesn't exceed it, and it's only till the fourth one is joined that the consolidation is achieved. And that doesn't even guarantee that the industry will somehow become healthier. So this just indicates that there's a long ways to go for Europe to consolidate containerboard. Not saying it's not possible. There are ways that it might be achieved, but it's a long ways away. And in fact, European containerboard has been deconsolidating over time. This is 07 to 15 again, and this is another HHI chart showing European containerboard actually having less concentration and at a low level than it over time. And it's because of things like this. Mondi just divested Roebling Mill, or announced it. It's still we will still operate, of course, but divesting to a smaller company will tend to decrease the concentration. Right now, let's take a look at another grade. In this case, uncoated fine or uncoated freesheet. I circled the 3 big producers of uncoated freesheet: Mondi, Portucel, and Stora. And in this case, it would take merging all 3 of those to achieve concentration. And once again, I'm not suggesting that this is how it should be done. I think in this case, it's highly unlikely that it would go this way. Mondi and Portucel are very low-cost producers, and not sure why they would entertain buying a higher cost producer and raising their average cost. So if uncoated freesheet were to consolidate, it might take a different route, but just using the same measure as we did for containerboard, it would be the top 3. So coated papers, in this case, it's a little further on, and the top 2 would just achieve concentration. As you can see, 22 and 18 would get this industry into consolidated shape, and you can see that the number of slices in this pie is actually much smaller, and the all other slice is actually pretty small. So coated papers is the closest segment to consolidation in Europe that there is. And it's been consolidating over time, gradually, and it's reached a level where maybe somebody would just begin to consider it nearing concentration. A regulator in North America typically wouldn't even worry about an industry until it achieved 1,500 or 1,800 HHI, and small increments above that probably wouldn't get examined very carefully either. So Europe's coated papers industry has still got a ways to go before it achieves any measure of concentration, any full measure of concentration. And lastly, consumer packaging. So we looked at packaging in terms of liner medium, containerboard that is, but there's a number of others, as FBB and SBS and craft papers and so on. So what about them? And I think you could agree by looking at this that if you take all of these together, the consumer packaging is a pretty far ways from concentration in Europe. But no, I'm not convinced that all those grades compete with each other. So let's break them down. CRB on the left, coated recycled board, FBB, craft paper, SBS, SUK, and uncoated recycled board, or URB. And you can see there's differences in the amount of consolidation. URB grades don't really compete in FBB applications generally, so it is possible that portions of European consumer packaging might achieve a level of concentration before other ones. And then lastly, I said there were 4 drivers we were going to evaluate. One of them, we'll just take a quick look at succession. And we've looked at succession in terms of who owns the industry. In this case, you can see that private hands own a greater proportion of European capacity than in North America. It doesn't mean that there'll be more or less M&A, but that there may be perhaps different reasons for it. Europe may have more M&A events triggered by succession than in North America. All right, let's have share some thoughts on how this may unfold. First of all, I'd like to get you to agree that there is a clear need in Europe for, at least for many companies, to find a way to share fixed costs and thereby reduce the average fixed cost per ton of its business, increasing margins and increasing its survivability. And parallel to that, there's a clear need for some companies at least to find low-cost manufacturing platforms. We saw that steep curve in linerboard. That also occurs in other grades as well. And there being a threat of bankruptcy, this is not an idle need. This is something that will catch high-cost producers one way or another. They'll either join somebody else or leave the marketplace. There will be some succession-driven needs, and there's a lot of other positive M&A drivers that I didn't discuss today that will most likely drive M&A activity in Europe. But there's one obstacle to M&A proceeding apace as it did in North America, and that's that there's a less clear path to consolidation in many segments. And the consequence of that is that M&A in Europe in most segments has to rely for its return on cost reduction and efficiency gains, as opposed to also getting price gains or margin gains from consolidation. And that means that M&A deals in Europe have to be done more carefully than they do in other segments where there is concentration, perhaps even more carefully than they would have to be done in say North America. So we'd like to propose an approach to thinking about M&A in Europe, and it's because there are 463 companies in Europe and they're operating 854 mills. That's a lot of numbers to comb through in order to find the right combination. And finding good combinations for M&A is probably a little bit like finding a spouse. You have to have lots and lots of understanding and compare lots of factors and have lots of information in order to make a good match, and even then it doesn't always succeed. So we think that that the way to do it is not only by finding a hypothesis or a thesis when meeting people, but also with an active or proactive approach that takes the thesis you have and searches the whole landscape for evidence that thesis can work. So let's say, for example, the thesis is a roll-up within a grade, and you want to find the right mills to do that roll-up with. And I'll just take you through a conceptual approach. I'm not going to name names here, but so let's say that we put all the mills on a grid. On the x-axis, it's we're representing the size of the mill, and the y-axis we're representing cost position. Now you'll see that the axes show 0 to 10 scale. We're using the Fisher Solve viability benchmarking tool to do this because you can't compare the cost per ton of one grade to another. It just costs more to make coated papers than it does to make linerboard. So you can't use actual dollar numbers. We have to reduce them to a 0 to 10 scale, comparing peers to peers only. So that's what we've done here. You can see that in the lower left-hand corner are the big low-cost mills, and in the upper right-hand corner are the small high-cost mills. Each one will have very different motivations and benefits, of course. In the lower right-hand corner, these are the mills that need scale. And in the upper left-hand corner, these are the mills that need low cost. So if you've got a thesis and you've got data, you can start to weed out the ones you want to focus on. So just imagine you picked one of the quadrants to focus on. Now I'm going to weed them out a little bit further. In the next slide, some of these green balls are going to disappear because let's say the roll-up strategy posits that privately owned companies are easier to buy at lower prices than publicly held ones. So we have eliminated the publicly held companies and kept the other axes. And then let's say you've eliminated some of the grades as not really being close enough to concentration to be doable. You really only want to participate in areas where concentration could come along. So we'll eliminate even more of the green balls, leaving just a few left. And if you keep doing this, of course, you'll end up with a short list. And if you're lucky, you'll end up with some good candidates, which you would then go evaluate. If you are a Fisher Solve user, you'll be familiar with many of these grains. You'll use some of the deep data in Fisher Solve to understand the assets and production furnishes and so on of each asset. In case you haven't used it already for screening, you just use it for deeper understanding. There'll be a number of views you can use. And then if you get that far, you'll do due diligence. Due diligence this here shows just the top of a long list of things you would check. And we didn't invite you to come talk to us if you were thinking along these lines. So I'd like to leave you with the thought, the story I've tried to tell today, that Europe does need M&A, but fragmentation makes M&A deals harder to justify, and therefore deal makers just need a deeper level of understanding and analysis to get that justification. We can help you supply some of that understanding, and again we'd encourage you to come talk to us if M&A is on your mind. And as I said at the beginning, I hope that I may have inspired you a little bit to use Fisher Solve in some creative ways to address some of the issues that face you.